From New York City for our viewers worldwide, I'm Matt Miller as we kick off a shortened trading week. The countdown to the open starts right now. We begin with the big issue, counting down to PCE.
What could drive us down? I think we're pretty fairly priced for a Fed that, kind of maybe cuts once, moderating inflation, maybe a little stickier than we initially thought. But if we start to really see inflation expectations deteriorate, in terms of moving up, if we start to see the Fed narrative fall apart again, there's a little bit of downside risk to this market, and I think that's underappreciated.
Joining us now to discuss is Scott Chronert, Citi U.S. equity strategist and managing director. Scott, great to have you on the program with us. Happy Tuesday. I guess shortened trading week here, but all eyes remain on the Fed. What do you expect in terms of cuts this year?
Well, the Citi economics view is that we're still looking at a series of cuts beginning with July, with our economists projecting as many as 4. I think the market is probably somewhere in between, and I do think from my perch that there is plenty of reason here for the Fed to begin to get ahead of the narrative in terms of rising unemployment or employment issues, ongoing deceleration in inflation from a structural perspective. And so I think we just have to presume that as we move through the balance of this year, we are looking at a peaking and inflection in what has been sort of a 2-year time frame of Fed hawkishness.
What do you make of growth? I noticed a note from Torsten Slok earlier pointing out that the strong earnings point to more corporate investment in the coming quarters. How does growth look to you right now in the U.S.?
I mean, earnings growth looks really good for us. We've been projecting 245 in earnings for the S&P for this year since middle of last summer. And so, let's call it double-digit earnings growth. What we have to remember here, Matt, is that in our view, the S&P 500 is not as much of an indicator of Main Street as one might expect. And so where we're looking for economic growth to begin to slow to, let's call it levels that are sort of sub 2%, that's not a big deal from our math in terms of in S&P 500 fundamentals, where we think we're looking at, as I mentioned, sort of a double-digit opportunity for this year that should have room to follow through into 2025.
Which is because you don't think stocks are overvalued, right? I mean, it feels pretty toppy here because we've had so many record highs. I think 25 record highs so far this year to date, but we're only looking at, what, 20 times earnings?
We're looking at 20 and a half times forward earnings. So I think, the valuation discussion comes up all the time. Going into this year, we were looking for 21 times for the S&P, and many thought that we were being aggressive with that. Now here we are, 22 and a half times trailing, and investors seem somewhat comfortable with that. But that's completely explainable by the weighting impact of the mega cap growth companies, which carry an inherently higher valuation and their influence on the index overall. We're not concerned about valuation. What we are concerned about is the ability of fundamentals to grow into and justify the valuation. We think we're in good stead right now, but we do have to acknowledge that from a sentiment perspective, things have run pretty far, pretty fast, and our sentiment indicators are flashing a little bit more euphoria, which leaves us with a little bit of a pause near term.
I do think that the weighting point is a really important one, though, Scott, because, typically we see more like 17 times as an historical average, but you don't have these big tech, these big growth companies, such a huge weighting of the S&P 500. Put a pin in that for right now, because I want to get back to the inflation discussion. Traders looking ahead to the Fed's preferred inflation gauge on Friday. It's still so key what happens with rates. Bloomberg's Michael McKee joins us now for more on the week ahead. Michael?
Well, we got a reasonably busy week, Matt, but it's basically the end of the week that everybody's going to be looking at. Consumer confidence today will have an inflation element. They do have an expectations index. Doesn't get as much publicity as the University of Michigan. Kashkari has spoken once today. Will speak again. He's basically saying the same thing as everyone else, higher for longer. If you want something other than PCE inflation to focus on, John Williams, the New York Fed president, on Thursday, he's going to be talking about about the economy, it appears, and he's going to have a text, and it may be a message-sending speech. But Friday is the main event, PCE inflation along with income and spending. The interesting thing about the PCE is for the last 6 months or so, it has come in lower than economists forecast. We'll see if that continues. This time, economists forecasting no change. So that could be something that really moves the market on Friday if we get a little bit better than expected numbers, and I know some analysts think we will. Then you take a look at what's going on for the basic, and this got this wrong, this chart. I made this wrong. So pay no attention to the 82%. That should be 82% chance of a one move in November. It should be 140% for December and 170% for January. That's my fault. But basically, we flip that around and you can see what the thinking is. End of the year is the time we're going to see anything. Let's see by the end of this week when we finish up with Fed speak, go into the blackout period, and see PCE whether or not those numbers hold.
All right, Mike, thanks very much. Michael McKee there talking to us about expectations for inflation, PCE at the end of the week, and for the Fed cuts at the end of the year. Scott Chronert, Citi U.S. Equity Strategist and Managing Director, still with us. And you expect the cuts to start, you just said, in July. Does the election have any bearing for you on what happens this year in terms of Fed policy?
Well, in my view, I don't think the Fed is going to want to wade too far into the election path, if you will. And again, I think the angle here is that we've come pretty far in terms of the inflation deceleration dynamic. We get it. Higher for longer makes a lot of sense right now. But I think if the Fed's going to move, I do think sooner, is better just a distance from the election, which is going to be a whole different set of discussions as we flip the mid-year and begin to go into the second half of the year.
Now, Scott, does the Fed just want to cut? Do they want rates, at some point when they're able to be lowered, or do they have to cut? Meaning, do you see weakness coming through in the labor market? Do you see the broadening out of good earnings fizzling? How does that work out?
Well, I think from our perch, the issue here is where you want to be relative to the underlying economic circumstance, right? So if you become data dependent, which the Fed, I think, pretty clearly is, and you wait for the data to show signs of the deterioration that would then trigger the need to cut, you're almost too late. You've put yourself back behind the circumstance. So what we think is that the Fed is admittedly quite restrictive here with Fed funds near 5.5%. There's still some debate of where eventually Fed neutral is going to be. But we think where we're setting up here is that the Fed can begin to flip the switch and lower Fed funds rates in a way that begins to take some pressure off of other things breaking, if you will, get ahead of the ongoing deceleration that's unfolding under the surface, and still be restrictive net relative to this higher for longer inflation setup. So we think there's lots of arguments here for the Fed to begin to show a pivot as we get into the late summer, let's call it early fall. Distance from the election, got that. But I just think very importantly here, the angle is that we do think that the underlying economic condition is showing enough of an ease that the Fed is going to have room as the summer unfolds.
The Magnificent Seven have been doing well no matter what. Even as the Fed raises rates, they're still the outperformers. If the Fed cuts, does it help them, or does it help, the 493 better?
Yeah, it's a really good question, and something that we've been focused on recently. So, what we would say is that there's this balancing act, right? We're talking about the Fed and Fed funds. We tend to view the 10-year nominal yield as more relevant to the valuation dynamic on the Mag 7 and the mega cap growth cohort. So we're very focused on 10-year nominal direction from a discounting perspective for that part of the market. But in aggregate, what's unfolding here is that you've got a new growth driver in town, courtesy of this generative AI theme that's been unfolding for over a year now. And that right now is become a bit more of an important discussion point than the traditional Fed discussion and where we are with economic activity. So what we're suggesting here is that there's a couple of things going on. New growth driver, which is probably more than offsetting some of the traditional expected influence of higher yields on the action. But as you flip the switch and you do get closer to Fed easing, our argument is that that sets up for a bit more of a broadening down the market cap spectrum into small mid cap.
So, I mean, the Russell 2000 is a huge underperformer, for example, this year. I think it's only up 2 or 3%. And,
Right.
you know, the NASDAQ, the S&P are up double digits. The Dow is also an underperformer. I don't know if you care, but as an older person, I still look at the Dow Jones Industrial Average. What do you think about, you know, those two ends of the spectrum, right? The blue chips and the smaller, small to mid caps.
So if you look at the way this year has unfolded, I got it. We've got information technology and communication services really been driving the performance bus for the better part of this year. But going off of the rally since last November, you've seen other parts of the market. You've seen industrials and financials kick in. During Q1, we saw energy go into a pretty strong move. Quarter to date, utilities are your strongest performing sector. So within the S&P 500, there has been a lot of sector rotation going on over the past 6 months. That is part of how this market is ticking higher. As you go down cap, though, you do increase your natural economic sensitivity. And this is why we come back to that Fed pivot point. We get to the other side of the Fed hawkish narrative, begin to see some pressure come off. That should have positive implications fundamentally for that part of the market that, oh, by the way, does tend to carry lower quality debt ratings on its companies. And you begin to set up for an earnings improvement that we think can run into the better part of 2025. So the broadening effect continues to play out in different ways. Going down the size spectrum, we think, is a pretty good strategy as we go into the second half of the year.
What do you think about the groups? I mean, I look at the breakdown of the S&P 500, the 11 industry groups, and as you point out, you know, communication services and tech have been doing the best, up about 20% year to date. But if you look at the bottom, consumer discretionary is pretty much flat year to date. Real estate is down year to date. What do you make of the groups going out the rest of the year?
So as we think about the positioning from here, now again, we keep coming back to this Fed pivot discussion point, right? And what we've begun to argue going into Q2 is that we want to begin to extend our positioning bias into those areas of the market that should be a more direct beneficiary of easing rate pressures. So we actually went overweight consumer discretionary going to Q2. We lifted utilities from a long-standing underweight to a market weight, lifted staples, we're overweight banks. So the point here is that we're trying to focus a lot of our positioning views on what has been a barbell between growth and cyclicals that's now allowing for the perceived or expected beneficiaries of a Fed pivot to come into play. That would also include real estate, by the way. So we think the setup here is getting really interesting for some sector and industry group movements, again, going to be predicated on more signs that the Fed is nearing that pivot point.
Scott, great having you on the program today. Thanks so much for joining us. Scott Chronert there is Citi U.S. equity strategist and managing director, talking to us about the markets as we stand here in May. Joining us with a look now at the stocks moving ahead of the opening bell today is Abigail Doolittle. Abby, what do you got?
Well, Matt, let's start out with the shares of GameStop. They are up in a big way, up more than 20%. This after the known to be meme stock. Today, it's not for a meme mania. It's for the fact that the company raised $1.6 billion, or excuse me, raised nearly $1 billion. The stock is on track for a $1.6 billion market cap. And as you had pointed out, I think last week or the week before, not so long ago, this was a $10 stock. It is now a $24 stock. Nvidia, the rally quarterly results continues, up 3% after rallying about 12% off of those strong results and the outlook. And then finally, Apple, a nice rebound here, continuing, Matt, up 1.5%. There is a report that the China iPhone shipments rose 52% in April. So some of the weakness that we had been hearing about, apparently there's a rebound. More on that on the open.
We have T+1 settlement going into action. Abigail, something I'm sure you've been watching at least since the GameStop hearings. What do you make of, the effect on the action? Are we seeing people nervous or traders sitting on their hands a little bit, as this goes into effect?
It's sort of interesting, Matt, because all I can think about is the many times that I had to take licensing exams, including that Series 7, the T+3. You always hear about the T+3, but the change to T+1. I think it's to be seen what the effect will be in terms of trading action. Let's talk about it more in a few days.
Yeah, absolutely, because, double settlement tomorrow, T+2 coming from Friday because of the Memorial Day holiday, and then T+1, both will hit tomorrow. Abigail Doolittle, thanks very much. Coming up, Wall Street returns to, as I said, T+1 stock trading for the first time in 100 years. We'll discuss the potential issues that loom next. This is Bloomberg. Wall Street is switching to the system known as T+1 today. It means stock trades will now settle in one day for the first time in 100 years. For more on this, Kriti Gupta, co-anchor of Bloomberg Markets Today, joins us, as well as Bloomberg cross-asset reporter Isabelle Lee. Kriti, I heard you talking about this morning. I thought you explained it perfectly. So when they said, we need to do this story, I said, get Kriti on the horn from London. I didn't realize we had been T+1 in the roaring 20s, and then it was just too much to handle.
It literally was too much to handle. It was the meme stock craze back in the day when you had all these institutional investors basically holding on to the cash. And then you had these bucket traders. Anyone who's watched or read, I should say, Reminiscences of a Stock Trader will know this story well. The volume was so large that it had to deal with that settlement, that immediate settlement. And it's that kind of deja vu, Matt, that we're having a century later in 2021 that has rattled not only portfolios within the states, but outside of the states, specifically for investors in Europe and Asia that are really just trying to play a little bit of catch up when it comes to that. And that's really what's been driving this entire push.
It all seems so antiquated. I mean, why do we have T plus anything, Isabelle? We've had the blockchain around for, 15 years now. Why don't we go to T+0?
So 100 years ago, it was indeed T+1, but we drifted away from that because of just the sheer volume. We needed more time to settle, at least for now, or at least since last week. You have 2 days between when you press the buy button until when trades settle. And then because of the GameStop era, a lot of the regulators were like, hold on, we need to minimize the risk. And that's really what this is about, to minimize the risk for investors. So then they're trying to move into T+1. We have Canada and Mexico moving yesterday. U.S. moved today, which is why tomorrow is what they call the double shift settle day, because we're going to settle trades of Friday and trades of Tuesday. So a lot of still moving parts here. We have the currency market, the ETF market, which is what I covered, all the other markets moving into T+1. And you're right, we're back to where we started. But yes, when I was talking to my sources about T+1, many are asking that they're gearing up for T+0. So we can't just really take a break now. T+0.
Kriti, you have a truly global perspective on this. You've been talking with market participants from around the world all day this morning. What do you hear from people in other jurisdictions that have different settlement rules, and what are the problems going to be as, foreign traders look for dollars or different jurisdictions' regulations fail to match up?
Well, in theory, this is all about efficiency, right, Matt? The idea here that you want to be able to catch any sort of failed trades. If someone puts up the money for a trade but can't actually fully execute, you want to be able to catch that. It's kind of risk management, which is why you can't go to T+0. But there are ripple effects. There's actually a really great macro read through here. The timing is perfect because not only are we talking about efficiency here, but remember, for international investors to get into the American stock market, they have to have the dollars first to do that. Now, you're coming in an environment where net, if you look at the CFTC data, you are positioned long dollar right now. So a lot of folks are already sitting on a pile of cash, literally sitting on dollar bills to be able to execute this trade. And that's important because that is a multi-trillion-dollar market, bigger than your bond market, bigger than your stock market, that is only dealing on a T+2 settlement as opposed to a T+1 like the stock market or the bond market. And that's where you see the ripple effects become a much, much bigger deal. So investors are saying, look, there may be some teething pains here to catch the failed trades, operational glitches. Jeffrey has a little bit of a cash cushion. Citigroup, SocGen talking about extended hours, more staff. But net, they're hoping that this will ultimately bring everyone onto the same page.
All right, Kriti and Isabelle, thanks very much. Isabelle Lee covering cross-assets here, markets here in New York, and Kriti, of course, anchoring Bloomberg Markets today with Guy Johnson, the James Bond of Bloomberg, out of London every morning, 7 to 9 London time. So what's that? 4 to 6. 2 to 4, 3 to 4, whatever. 7 to 9 a.m. London time. You can catch her every morning. Coming up, the morning calls, and then later, Invesco's Brian Levitt joins us around the opening bell as investors gear up for another key inflation print this week. We'll get our timing right. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up is Mitsuho upgrading Norwegian Cruise to a buy, expecting shares to benefit from the improving macroeconomic outlook. Next up is Argus downgrading Southwest to a hold, pointing to rising expenses and recent delays to aircraft deliveries. And then finally, Wedbush upgrading Airbnb to an outperform, seeing an attractive valuation with healthy demand for the summer travel season. In terms of the pre-market moves, we don't have a lot, although the direction is the same, whether you look at the S&P 500 up 0.2%, the Russell 2000 up 0.7%. As we just heard from Scott Chronert, Citi thinks that rate cuts will benefit small caps more than they will the broader market. We'll see how it works out today ahead of the market open. Just about 5 minutes to go, but of course the PCE data on Friday is what we're all looking forward to. Coming up, the market open, we'll speak to Invesco's Brian Levitt at the opening bell, weighing in on stagflation fears. Does he think they're overblown, and the risks from the looming U.S. election? This is Bloomberg. This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. Got a little bit of momentum ahead of the long weekend. It's a shortened trading week. Remember, today's the first day after yesterday's Memorial Day holiday. We're looking at a gain about 0.1% on S&P futures. We're waiting for the PCE reading on Friday, but there's a lot that can happen between then and now. Fed speakers, for instance. We do see Russell 2000 futures a little stronger, so small caps maybe looking at some more movement today. But there you have it, the opening bell. So we're kicking off trading right now. And we're going to also continue to watch the other assets. So the euro right now trading at $1.08 and change. The U.S. 10-year yield at 4.45, and NYMEX crude currently up just about 2% at 79.24. One of the stocks that we're watching at the open, and one of the reasons maybe for positive momentum this morning, is Apple. The iPhone staging a comeback in China, with shipments rising 52% in April. Abigail Doolittle is here with more. Abby?
Yeah, we do have the stock solidly higher, up more than 1%. And it's quite a rebound because earlier this year we did have these reports of the iPhone demand out of China being relatively weak. But to your point, in the month of April, according to the China Academy of Information and Communications Technology, there was a surge, and that roughly 3.5 million units came from the foreign brands, but that there was a surge in smartphone shipments in China, and that there was that 52% rise for Apple. Now, interestingly, Matt, there's been a ton of volatility for this stock. It had been down nearly 20% from a December peak to an April low, now up more than 18%. And I believe today is one of the first days this year that it's actually trading slightly higher on the year. But because of that big decline, it's still lagging the S&P 500 on a year-to-date basis by, let's call it, 10 to 11%, but slowly trying to make up that gap on some of this apparent iPhone strength.
All right, really interesting story there, especially as they cut prices in China and get more discounts so more people can buy the iPhone. We'll continue to follow that. Let's turn to online gambling. DraftKings falling as progressive sports betting tax passed in the Illinois Senate, posing a headwind to the operator. Isabelle Lee has more on DraftKings.
Hey, Matt, shares are falling around 8%. This is the lowest level since January, and analysts are saying that investors are concerned that other states will follow suit. So according to reports, the legislation passed would make Illinois the second most expensive state for wagers to do business in. So operators will now be liable to increase taxes based on their adjusted gross margin. So this will be around 20 to 40%, up from the current 15%. So if approved by the House, the new tax will take effect in July 1. So shares of FanDuel, that's another operating gambling operator, fell as well. And we have Goodbody analysts saying that DraftKings may be facing a $59 million hike. We also have Needham expecting a $44 million hike. So we're talking about big numbers here, and investors definitely aren't liking that. We have also analysts pointing out that, you'll never know what will happen. New Jersey is considering a similar tax hike, but we have Massachusetts rejecting one last week, Matt.
All right, so a lot of movement in the online gambling world. Isabelle Lee, thanks very much for that. Let's turn to meme stocks. GameStop extending its rally after raising almost $1 billion in a share sale, capitalizing on a flurry of trading earlier this month. Katie Greifeld is here with more. Katie?
Once again, we are talking about GameStop because, you can't ignore what's going on in the shares. Up 15% so far today, and it's for exactly what you said. The company completed its share sale program, raised nearly $1 billion in that process. So similar to what we saw with AMC this past month, really striking while the iron is hot and taking advantage of this month's meme stock resurgence to raise funds. The proceeds of the sale will add to GameStop's cash pile. Prior to the sale, that clocked in at about $1.1 billion, and it plans to use these proceeds also for general corporate purposes, which may include acquisitions and investments, so remains to be seen. It's interesting to see a stock rally, 17% after actually raising or selling shares. Not typically what you would expect, but that is really the story of these meme stocks. You wouldn't necessarily expect GameStop shares to be up nearly 60% in May, but Matt, that's exactly what has happened.
Yeah, I wouldn't expect a brick and mortar video game retailer in 2024 to be worth, $7 billion. But that's Wall Street bets for you. Katie, thanks so much. Brian Levitt, Invesco Global Market Strategist, weighing in on the economic environment in the U.S., writing, no sooner had I grown accustomed to the panic over hyperinflation than I was told of the forming economic hurricanes. Now it's stagflation. Hyperinflation and economic hurricanes at the same time. Make it stop. He joins us now to talk about, I guess, moderation. Should we be a little bit calmer, Brian? You don't like all the superlatives.
I don't like the superlatives. In fact, I've been quoting Saturday Night Live from the 90s with stagflation. Linda Richmond would say it's neither stag nor inflation. Discuss. Remember, this is an economy that has been resilient. There's an unemployment rate that's historically low, and inflation's coming down. Yeah, there's some months where maybe it's a little bit stickier and there's some nuance in the data. But if you look at a misery index, which is unemployment plus inflation, it's well below the long-term average. This is not stagflation.
I had to Google it, actually. I think it's Mike Myers, right? The coffee talk reference there in terms of Linda Richmond, which thank you, because I then watched a couple of those skits. We do.
Happy to help.
We do, though, still see inflation that the Fed continues to worry about. We're waiting for PCE to come out on Friday. And I guess there are some pockets of concern about slowing growth. Which one to you is more important? Where do you think the Fed should err?
I would be more focused on the slowing growth. The personal consumption expenditure is below 3%. And so we could quibble what the 10th place should be. Should it be 2.9? Should it be 2.5? The reality is it's generally near the Fed's comfort zone. The longer that they stay tight, the more implications you have on the economy. So in my opinion, the 5.25 Fed funds rate is too tight. for the environment that we're likely to find ourselves in. That's a rate that was required when inflation was 9.5%, not when it's 3 or in the Fed's preferred measure below 3. So I would like to see the Fed slowly starting to normalize the yield curve. But they're going to want to continue to wait until they're fully convinced that inflation is behind us.
Isn't it a concern to you that inflation is off to the races if we do see cuts? Because, I don't feel very restrictive in terms of this economic policy other than, the housing segment. We hit all-time highs in the stock market. If you look at FCON Go on the Bloomberg terminal, you can see that financial conditions are not very tight. Don't they just add fuel to the fire of inflation if they cut rates?
Well, the challenge, Matt, is that the Federal Reserve should be looking ahead, not looking at the current environment. That's the challenge of being data dependent. And when you're data dependent, you tend to end up making policy mistakes at some point. So if you're looking ahead and believe that the U.S. economy will moderate, things will start to slow down, then I'm not saying you need to cut rates aggressively here. I'm saying that you want to avoid the environment where you have to cut rates aggressively. You want to start slowly normalizing the yield curve because there will be lagged effects of all of this policy tightening. Now, nothing that I think will be disastrous, but the longer they wait, the more that those lagged effects of policy tightening will hit the economy.
Do you have to look ahead to be bullish on stocks? Because if you look at trailing PEs, we're at more than 23 right now. Those are pretty high valuations.
Yeah, I don't think of valuations ever as timing tools. So valuations tend to matter more for your expectations for longer term performance. If you look at the broad market, a lot of the loftier valuations are in the top handful of names, which makes sense. A lot of those companies are delivering. The broad market's not that overvalued. You look at an equal weight index, it's trading slightly above average with its trailing price to earnings ratio. But I believe that markets are likely to continue to move higher. Typically, when you're in an environment where you've had peak inflation, peak interest rates, peak tightening, the next years tend to be good for stocks. That is, of course, if we avoid a recession. And you get, again, in my opinion, that's why I believe the Federal Reserve should start moving ahead of that rather than waiting to see.
What do you think about the broadening out? I mean, obviously, IT and communication services stocks have soared this year. They did well last year, too. We have some weak points, though, consumer discretionary, as I mentioned, housing, real estate. What do you think about the other non-Magnificent Seven stocks?
Well, if you remember in November and December, the market priced in 6 rate cuts quickly, and you had a bull market in small and mid-cap stocks. So that's what I would categorize as a broadening out. And that was my expectation for 2024, and yet it all happened in 2 months. So what the market's been doing more recently is backing out those rate cuts. And so any of the businesses that require lower rates or require some catalyst for growth did not perform as well as your structurally advantaged growth businesses. What you would need is the slow normalization of the yield curve. And I think the good news now is that the market and the Fed are much more closely aligned. The expectation should be, as we lower rates and normalize the yield curve, again, small, mid-cap, value-oriented tend to perform well. We saw it all in November and December of last year, likely offers some clues on what that broadening out could again look like in the right environment.
What do you think about the Dow Jones Industrial Average, Brian? I mean, you're a global market strategist. You've been in this market for 20 years. You went to Michigan, so I always think, bad at football, but very good school.
How can you say that?
Well, especially when you went there, right? I'm a Buckeye.
No, national champs when I was there, 1997, national champs.
Well, congratulations, I guess.
Thank you.
I thought you were there a little bit earlier. In any case, does the Dow matter? Because I'm looking at, the Russell 2000 is up only 2 or 3%, and the S&P and the NASDAQ are up 11, 12%. But the Dow is like right there with the Russell, even though it's supposed to be the biggest blue chips in the country. What do you think? Yeah,
it's become more of an index that requires a bit more of of a catalyst for growth. It's less of the structurally advantaged growth businesses, the AI businesses, the Magnificent Seven, et cetera. So, but I mean, the Dow has tend to be underperforming the S&P and the Nasdaq for a long while now, because we've been in an environment where we have not seen a meaningful acceleration of growth. We didn't see it for 15 years. We had it for a while coming out of COVID, and now we've had a fairly stable global growth environment for a while. So the Dow would need a bit more of a catalyst in order to outperform the other indices that you had mentioned.
All right, Brian, my apologies. 1997 national champions, University of Michigan alum, Brian Levitt there, also the global market strategist over at Invesco. Coming up, Apple staging a rebound in China.
There's a nationalistic approach and sentiment in China. Chinese products first. We have seen that over the years, and I think long term it will be a very difficult marketplace to operate in for U.S. technology companies.
That conversation still ahead. This is Bloomberg.
There's a nationalistic approach and sentiment in China. Chinese products first. We have seen that over the years, and I think long term it will be a very difficult marketplace to operate in for U.S. technology companies. I think Apple's majority of their profits and cash flows in the future will come from non-Chinese markets. So it's actually not a news item that I would put a lot of weight on.
Apple's iPhone staging a rebound in China, shipments rising 52% last month amid a flurry of discounts from retail partners. This comes after growth in March following steep declines in the first 2 months of the year. Bloomberg's Alex Webb joins us now for more on this story. So it looks like a real comeback for the smartphone king in China.
Yes, it does perhaps look as though Apple's demise in China was greatly exaggerated. There is a caveat, though, of course, that this is not a month when they tend to do, in relative terms, a large proportion of their sales. So it's easier to get a big increase. It's three and a bit million. The estimates are that they've hit now. In other quarters, they might do as many as 10 million. So by adding a million more in sales in this month, you get quite a meaningful number quite quickly. But it does look as though the pain is not quite as extreme as people were fearing back in 2016-17. We saw over a 2-3 year period their sales in China declined by about a third. It doesn't look as though it's going to be quite that drastic, but to the analyst's point earlier, they're not quite out of the woods yet.
All right, so they had a good month last month. Next month, I guess, is going to be good because of the 618 online shopping festival in China. It looks like AI stocks also continue to do very well. Nvidia getting a huge boost this morning, I guess, from the Elon Musk startup raising $6 billion to compete with OpenAI. And I think Nvidia said on the call last week that Tesla was one of its biggest customers for chips, or maybe Twitter will be as well because of Grok, and now xAI, which is Elon Musk's competitor to OpenAI, is seen with a lot of cash.
Yeah, and crucially, the difference is compared to, say, OpenAI or Google DeepMind, that it doesn't have one of those massive tech companies behind it, particularly a cloud company. Google, Microsoft are two of the companies that have been doing a lot of the purchases of Nvidia's, bleeding edge chips. That's been the big driving force behind the acceleration in their share price. And because xAI doesn't have an interest from one of these big cloud companies, it presumably then has to buy its own servers or get access to its own servers. One can therefore draw the line to the Nvidia share reaction that perhaps a good chunk of this $6 billion in new capital will be dedicated to acquiring their latest chips.
All right, Alex, thanks so much for joining us. Bloomberg's Alex Webb there talking tech and obviously some of the biggest movers in the market over the last year, 2 years, and certainly today, our tech, as we see Nvidia moving up almost 5% in early market trading. For some of the sector price action, some of the other sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. Abby, what are you watching?
Well, right now, Matt, we have the S&P 500 up ever so slightly, fractionally, really, perhaps about to flip to the red. Not surprisingly, then, more sectors are down. It's not a very well-based fractional gain. To the upside, energy up about 0.9% in sympathy with oil. We also have real estate higher, tech higher, so it's sort of a random mix that's higher. To the downside, healthcare, industrials, consumer discretionary, no sector up or down more than 1%. So the bulls and the bears still fighting it out. Where they're not fighting it out, where the bulls have clearly won, this is the chip sector. You were just talking about it. In fact, the S&P 500 semi-cap equipment index up 6 days in a row. That's the longest winning streak of the year. Over that time period, up nearly 12%. Not surprisingly, Matt, this, of course, has a lot to do with Nvidia, but it also has to do with Texas Instruments on that report of activist Elliott taking a $2.5 billion stake. So that is another piece of it, but it seems as though there's just a lot of good sentiment, certainly around that index at an all-time high.
Do we see any, Abigail, when you look at a shortened trading week like this, is it any different than when you look at all 5 days? I mean, do traders try and squeeze 5 days worth of trades into 4, or is trading lighter because everyone's taking long weekends?
It depends, Matt. On the news flow, it's interesting with the unfortunate news coming out of the Middle East that there's not more volatility for stocks, because that could sometimes be geopolitical issues, could, of course, be a hot button for more volatility. But investors seem to have that priced in right now, the idea that it's not going to affect the corporate profit here in the corporate profit outlook here in the U.S. The next event really is the Fed. So I think that we're treading water to some degree for the rest of this week. Probably not so different if it was 5 days or 4 days. And of course, there is the adage, whether people believe it or not, and how true it is, sell in May and go away. We are very much in the thick of that.
All right, Abigail, thanks very much. Abigail Doolittle looking at stocks and sectors for us. We will be right back with more. I'm Matt Miller. This is Bloomberg.
He was an avid sports fan, an avid Celtics fan, and everywhere he went, he proselytized to what a great experience it was to be a Celtic and be a champion. So the world and the NBA has had a major loss in Bill Russell, in Bill Walton, and 2 years before Bill Russell, two of the most iconic centers in the game. And we're going to really miss Bill, and hopefully our players will take extra heart into the games because of remembering Bill.
That was Celtics co-owner Steve Pagliuca on Bloomberg Television earlier, speaking about basketball legend Bill Walton. He died at the age of 71 after a prolonged battle with cancer. Michael McKee joins us now. And Mike, Bill Walton was a giant, not only on the basketball courts at almost 7 feet tall, but also at Grateful Dead shows. He reportedly saw more than 850.
Well, it's interesting. Nobody's been able to pin down the number because he always said thousands, and some members of the Grateful Dead said thousands. I guess he was always there. Mickey Hart, the drummer, just posting a short time ago on Twitter that he was his best friend. He became part of the whole culture of the Grateful Dead, and like they talk about the fifth Beatle, he could be the seventh.
Right. I mean,
seventh member of the Dead.
I've been going to shows since 1991, and I would always spot him in the crowd because he was so tall. He really stood above the rest, and obviously he stood close to the stage, so you could see him from the bleachers. He really talked a lot about the Dead as a team and compared them to his, championship-winning Celtics or Trailblazers or UCLA, where he won 2.
There's a funny story about the first time the Dead really noticed him. He was in the crowd, and Bobby Weir says, "There's a really tall person out there." And later on, Bill Walton said, "Yeah, I was there, and I really felt badly for the people who were standing behind me and couldn't see the stage." But he did integrate the two, and his life motto was always expect something good to happen. He was one of the most cheerful, happy people, always talking about how things can be better and how things could be good. And the band appreciated him as much as the rest of the world. You look at what happened with Twitter yesterday, he was it. That is all anybody wanted to talk about.
It's all about Bill Walton. Mike, thanks so much for joining us. Michael McKee there. This was the Countdown to the Open. I'm Matt Miller. This is Bloomberg.